Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to analyze Amazon stock. I'm going to explain why I believe Amazon is one of the best companies for long-term investing. I will explain why Amazon is likely undervalued now. Just to give you more context, at the time of making this video, the entire market is still in a large correction, mainly because of Trump's trade war with other countries. Trump has started imposing higher tariffs on China, Canada, Mexico, and even the European Union. Of course, the market is very concerned because Trump's trade war will likely cause high inflation in the US, at least for the short term. Moreover, Trump's trade war will likely lead to lower GDP growth and potentially a US recession if this trade war escalates even more. As a result, both the S&P 500 and Nasdaq 100 have corrected around 10% from their peak recently. At one point, the Nasdaq 100 was down as much as 13% recently. As for Amazon, like most other tech stocks, Amazon stock has dropped even more. Amazon stock has dropped around 19% from its recent peak. The good thing is that the current market correction is not as bad as the large bear market back in 2022 and early 2023. The current US economy is much stronger than before, while the US inflation is also much lower than before. The important thing is that Amazon's business fundamentals and long-term growth prospects have not changed at all. The only things that have changed are that Amazon's stock price is much lower than before and that the market is very pessimistic because of Trump's trade war. I always say this, the best time to invest in outstanding businesses is when the market is full of fear. So in this video, I'm going to talk about Amazon's long-term growth prospects over the next several years. Specifically, I will talk about Amazon's AWS business and its biggest growth catalyst going forward. I will also talk about Amazon's valuation. I will show you different valuation methods and explain why I believe Amazon stock is likely undervalued now. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing analysis videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make. So if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you'll know when a company becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. At the time of making this video, the market is still extremely fearful. Many US stocks are oversold and undervalued now. As I mentioned earlier, the market is concerned that Trump's trade war will cause high inflation in the US, lower GDP growth, and potentially a US recession in the upcoming months. This is why many retail investors and large institutional investors have reduced their positions in US stocks. Many investors and fund managers have switched their investments from US stocks to more money market funds, bonds, European stocks, or even Chinese stocks. Here's the deal. No one can really predict the market accurately in the short term. The S&P 500 may decline slightly this year, or it may recover by the end of the year. Trump's trade war and reciprocal tariffs on other countries will likely lead to higher inflation in the US, at least for the short term, and potentially lead to lower GDP growth. To fight inflation, the Fed will likely need to hold high rates for longer and delay cutting rates to next year instead. In my view, it does not make sense to sell US stocks when they are oversold and undervalued. US stocks in general, as represented by the S&P 500 and the Nasdaq 100, tend to outperform European stocks and Chinese stocks in the long run. The main reason is this. The US has many more high-quality companies than Europe and China. It's home to the most profitable, most innovative businesses in the world. Plus, the US has the strongest economy compared to other countries. So, betting against its long-term growth doesn't make sense to me. Personally, I'm not too worried about this market correction. The entire market will eventually recover and reach new highs again. We just need to be patient and keep buying and holding the best companies. Just to give you an example, let me show you one of my investment accounts. This account has performed exceptionally well over the years, even after many market corrections and several bear markets. My investing strategy is to keep buying and holding the best companies that are most competitive and most profitable in their industries. For example, in this account, I have invested in MasterCard, Microsoft, Visa, Amazon, TSMC, Google, Meta, and SML. Many of them have already become multi-bagger stocks after holding them for many years. So regardless of the current market correction and the trade war, I will continue holding these outstanding businesses for the long term and let them grow much more over time. Oftentimes, the best investing strategy is to ignore all the market noise, then just buy and hold the best businesses for the long term. They will continue growing exponentially over time because of their strong fundamentals, large economic moats, increasing earnings, and increasing free cash flows. If I have extra cash, I will keep adding to these positions and buy them only when they're undervalued. This long-term investing strategy has worked exceptionally well for me over the years. Let's go back to Amazon. What are the biggest risks we should consider that may impact Amazon? As of now, there are two biggest risks we should consider that may impact Amazon in the short term. First, Amazon's e-commerce growth is largely dependent on US consumer spending and US economic growth. As long as the US economy is still strong and inflation stable, US consumers will continue shopping more on Amazon every day. However, if Trump's trade war leads to higher inflation, lower GDP growth, higher unemployment, and potentially a US recession, Amazon's e-commerce business will likely slow down for at least several quarters. Here's another thing we should consider. If you look at these past financials, you can see that Amazon has had consistent revenue growth, operating income growth, operating margin expansion, and free cash flow growth over the years. Amazon used to have very high double-digit growth rates before. However, Amazon is much larger now. Its 600 billion plus revenue base is much larger than before, so we shouldn't expect Amazon to have high double-digit growth rates like before. According to this consensus forecast, Amazon's total revenue is expected to grow by approximately 10% to 11% annually over the next 3 years. Its EPS is projected to grow at a much higher rate during this period. This will be driven by ongoing cost reductions and increased efficiencies in data centers and fulfillment centers, which lead to high margins. Of course, these expected growth rates assume that the US will not have a recession. Here is the second biggest risk we should consider. Amazon is planning to increase its capex to around 100 billion this year. This is a huge increase from last year's 83 billion capex. Of course, most of this 100 billion capex will be invested in AI infrastructure to support AWS internal and external AI workloads. This means NVDA will earn higher revenues from Amazon this year. The biggest concern is that AWS revenue growth has slowed down in recent quarters. Similar to Google Cloud and Microsoft Azure, Amazon's management stated that they are currently facing capacity constraints. Amazon's management said that their AWS business would have grown faster if they had enough AI compute and more power for their data centers. Also, investors are concerned that Amazon may not be earning enough returns or ROI on its substantial investments in AI infrastructure. More on this later. Let's talk about Amazon's long-term growth prospects. I will explain Amazon's largest growth catalyst going forward. First of all, if you want to understand Amazon's long-term growth prospects, you have to look at Amazon's major businesses. Amazon's major businesses include Amazon online stores, physical stores, third-party seller services, which include Amazon's fulfillment and delivery services, advertising services, subscription services, which include Amazon Prime, and most importantly, Amazon Web Services AWS, which is Amazon's cloud computing business. Based on what I know, Amazon's online stores, physical stores, and third-party seller services have very low margins because Amazon has to keep prices low to compete with Walmart and the Chinese online retail stores. Building fulfillment centers around the world and providing fast delivery services to customers is very expensive, so it makes sense that these businesses have razor-thin margins like Walmart. Also, these businesses are very mature. I believe their growth rates will likely be in the single digits instead of double digits going forward. The positive side is that Amazon's online retail business has a huge economic moat. It's extremely hard to compete with Amazon in North America because Amazon has the most product selections, the fastest delivery services, the best customer service, and the lowest prices across many product categories. Amazon's large economic moat also comes from its network effects. Amazon has the most users and sellers in North America. This in turn attracts more users and sellers because sellers want to sell more products on Amazon, while users want to find more and better products on Amazon. So even if users can find cheaper products at Walmart, eBay, and Chinese online stores, most will still buy from Amazon first because of its extremely fast delivery services, excellent customer service, and Prime membership. Outside of the e-commerce business, advertising and AWS will be Amazon's largest growth and profit drivers. Here, you can see that Amazon's advertising business and AWS have been growing much faster than other businesses in recent quarters. More importantly, Amazon's advertising business and AWS have much higher margins than those of its online retail business. Based on analysts' estimates, Amazon's advertising business operating margin is likely over 50%. This is exceptionally high compared to Amazon's other businesses. Here's the important thing to know. In the most recent quarter, Amazon's quarterly ad revenue reached $17.3 billion. According to Amazon's management, Amazon's ad revenue has reached an annual run rate of $69 billion. In comparison, Amazon's ad revenue was at $29 billion 4 years ago. At the time of making this video, Amazon's ad business is already the third largest player behind Google and Meta. Going forward, I believe Amazon's ad business will continue to grow at a slightly higher rate than Meta and Google's ad businesses because there's a large demand for Amazon ads. Third-party sellers will continue investing in Amazon ads because they want their product listing to be on the first page so customers can see their products first when they search for products on Amazon. You may wonder, what about Amazon Web Services or AWS? You may know this already. Amazon's cloud computing business, AWS, is its most important and most profitable business. AWS has been contributing the most profits to Amazon for many years already. For example, last year, AWS contributed about 58% of the company's total operating income. In comparison, Amazon's North America business contributed about 36%, while its international business only contributed about 2.7% of the company's total operating income. Moreover, AWS' 37% operating margin was much higher than Amazon's North America and international businesses' operating margins. In terms of cloud market share, AWS, Microsoft Azure, and Google Cloud (GCP) have been dominating the cloud infrastructure services market for many years. It's very hard to compete with AWS, Azure, and GCP because they have the most capital, the most data centers across different regions, the best cloud computing services, the most compute, storage, and networking, and the largest customer and developer base. At the time of making this video, AWS has a market share of 33% compared to Azure's 20% and GCP's 11% market share. Typically, large enterprise customers only have several hyperscale cloud providers to choose from when they want to move their enterprise data and applications from on-prem servers to the cloud. Most large enterprise customers would choose AWS, Azure, GCP, or Oracle Cloud because they have the best cloud computing services, the most data centers around the world, the most compute, storage, and networking, the best software, and the largest cloud ecosystems. Based on what I know, AWS has a huge first mover advantage over Azure, Google Cloud, and Oracle. AWS already has the largest customer base, the most developers and companies supporting AWS cloud services, large economies of scale, the most data centers across different regions around the world, and the most comprehensive cloud services for enterprise customers. Typically, enterprise customers tend to be very sticky customers. Once they use AWS, it's very hard for them to switch to other competing cloud services such as Azure, Google Cloud, and Oracle. As far as I know, it's very costly and time-consuming to move from AWS to other cloud services. Also, large enterprise customers and government agencies around the world will continue moving their IT workloads and data from their on-prem servers to the cloud because they want to reduce the operating costs of running their on-prem servers. I believe this trend will benefit AWS the most because large enterprise customers and government agencies tend to choose the best and most reliable cloud service providers when they want to move their IT workloads to the cloud. AWS is the market leader in cloud computing services, especially public cloud services. So naturally, most enterprise and government customers will consider AWS first whenever they want to move their workloads to the cloud. Here is another growth catalyst that will benefit AWS the most over the next 10 years. Outside of the traditional cloud services, the cloud infrastructure services market, which includes IaaS, PaaS, and hosted private cloud, has grown even more since ChatGPT launched in late 2022. The reason is this: generative AI and the large demand for more AI workloads, such as training frontier AI models and inferencing them in different applications, have increased the demand for cloud computing services. Many investors do not know this. There are several ways AWS can earn higher cloud revenues from AI services. First, on the training side, companies and AI labs that want to develop their AI models and AI applications need to rent AI GPUs from AWS or other cloud service providers. It's very expensive to buy thousands of AI GPUs and rack-scale AI systems from NVDA. For example, NVIDIA's Blackwell GB200 NVL72 rack system costs around $3 million for each system. Typically, you need to invest millions of dollars upfront if you want to build a large cluster of AI GPUs or AI supercomputers. Instead of buying AI GPUs and AI systems from NVIDIA, the best alternative is to rent them from AWS or other cloud service providers. Second, on the inferencing side, AWS earns revenues by hosting its own foundation AI models, as well as foundation AI models from other companies such as DeepSeek, Anthropic, Numa, MetaNama, Mistral AI, and Stability AI. Developers will use these foundation AI models to build their AI applications. Based on my understanding, when developers use these AI models through AWS will charge them based on the AI models they choose, the amount of input and output AI tokens that are used, and the cost per 1,000 AI tokens. For example, if you're a developer and you're using DeepSeek R1 to generate tokens for your AI app, AWS will charge you less than 1 cent for every 1,000 input tokens and also less than 1 cent for every 1,000 output tokens. As far as I know, this DeepSeek pricing is really cheap. Let's consider this. The cost of inferencing will continue to decrease significantly over time. This will lead to even more use cases, more AI capabilities, a greater number of AI applications, increased AI usage and AI demand, and higher returns on AI investments over time. Of course, this trend will benefit AWS significantly over the long term because the large demand for generative AI and increased AI workloads will continue to drive greater cloud spending for AWS. I talked about this earlier. At the time of making this video, AWS is still facing capacity constraints. According to Amazon's management, AWS does not have enough AI compute, networking, and power to meet customers' AI demand. This is why AWS, like Microsoft Azure, Google Cloud, and Oracle Cloud, are all planning to increase their capex this year to meet their customers' AI demand. Interestingly, according to a forecast from Synergy Research Group, hyperscale data centers are expected to expand their capacity at a much faster rate than the number of new data centers added annually over the next 5 years. Of course, the primary growth driver is AI workloads. To meet the increasing demand from both AI and non-AI workloads, AWS and other hyperscale cloud providers will need to significantly increase their cloud computing capacity and data center power. Overall, I believe this is a positive trend for AWS. Amazon will only increase its capex if there's a strong demand for AI workloads and traditional non-AI workloads. I want to share this earnings call with you. Amazon's management talk about AWS biggest growth opportunities going forward, why AWS is supply constrained, why they need to increase their capex to meet customers' AI demand and non-AI demand, why AI will drive higher cloud revenues going forward, and why cheaper AI models such as DeepSeek will lead to much higher usage, higher AI spending, and higher cloud revenues.
On the CapEx side, as Brian mentioned earlier, we spent $26.3 billion in CapEx in Q4, and I think that is reasonably representative of what you can expect in annualized CapEx rate in 2025. The vast majority of that CapEx spend is on AI for AWS. It's, the way the AWS business works and the way the cash cycle works is that the faster we grow, the more CapEx we end up spending because we have to procure data center and hardware and chips and networking gear ahead of when we're able to monetize it. We don't procure it unless we see significant signals of demand. And so when AWS is expanding its CapEx, particularly in what we think is one of these once-in-a-lifetime type of business opportunities like AI represents, I think it's actually quite a good sign, medium to long term, for the AWS business. And I actually think that spending this capital to pursue this opportunity, which, from our perspective, we think virtually every application that we know of today is going to be reinvented with AI inside of it and with inference being a core building block, just like compute and storage and database. If you believe that, plus that altogether new experiences that we've only dreamed about are going to actually be available to us with AI, AI represents for sure the biggest opportunity since cloud and probably the biggest technology shift and opportunity in business since the internet. And so I think that both our business, our customers, and shareholders will be happy medium to long term that we're pursuing the capital opportunity and the business opportunity in AI. So that's the CapEx piece. I think the second question you asked, Mark, is really around AWS growth and whether this is being moderated down at all by supply chain constraints. Well, it is hard to complain when you have a multi-billion-dollar annualized revenue run rate business in AI like we do, and it's growing triple-digit percentage year over year. It's hard to complain. However, it is true that we could be growing faster if not for some of the constraints on capacity. And they come in the form of, I would say chips from our third-party partners coming a little bit slower than before with a lot of midstream changes. It take a little bit of time to get the hardware actually yielding the percentage healthy and high-quality servers we expect. It comes with our own big new launch of our own hardware and our own chips in Trainium 2, which we just went to general availability at reInvent, but the majority of the volume is coming in really over the next couple quarters, the next few months. It comes in the form of power constraints where I think, the world is still constrained on power from where I think we all believe we could serve customers if we were unconstrained. There are some components in the supply chain like motherboards too that are a little bit short in supply for various types of servers. So, I think the team has done a really good job scrapping and providing capacity for our customers so they can grow. We're still growing at a pretty reasonable clip, as I mentioned earlier, but I do think we could be growing faster if we were unconstrained. I predict those constraints really start to relax in the second half of 25. And, as I said, I think we could be growing faster even though we're growing at a pretty good clip today. I think one of the interesting things over the last couple of weeks is sometimes people make the assumptions that if you're able to decrease the cost of any type of technology component, in this case we're really talking about inference, that somehow it's going to lead to less total spend in technology, and we have never seen that to be the case. We did the same thing in the cloud where when we launched AWS in 2006, where we offered S3 object storage for 15 cents a gigabyte and compute for 10 cents an hour, which of course is much lower now, many years later, people thought that people would spend a lot less money on infrastructure technology. And what happens is companies will spend a lot less per unit of infrastructure, and that is very, very useful for their businesses. But then they get excited about what else they could build that they always thought was cost prohibitive before, and they usually end up spending a lot more in total on technology once you make the per unit cost less. And I think that is very much what's going to happen here in AI, which is the cost of inference will substantially come down. What you heard the last couple of weeks out of DeepSeek is a piece of it, but everybody is working on this. I believe the cost of inference will meaningfully come down. I think it will make it much easier for companies to be able to infuse all their applications with inference and with generative AI. And I think it's going to, if you run a business like we do, where we want to make it as easy as possible for customers to be successful building customer experiences on top of our various infrastructure services, the cost of inference coming down is going to be very positive for customers and for our business.
Let's take a look at Amazon's expected growth rates going forward. According to this consensus revenue forecast from Seeking Alpha, Amazon's revenue is expected to grow by around 10% annually over the next 5 years. I believe these growth rates are a bit conservative. My base case scenario is that Amazon's revenue should grow by approximately 10% to 11% annually over the next 5 years because generative AI and the strong demand for AI workloads should boost AWS cloud revenues. In terms of EPS forecast, Amazon's EPS is expected to grow much faster over the next 5 years because Amazon will continue lowering operating costs, reducing the number of middle managers, and improving efficiencies across its data centers, fulfillment centers, and delivery networks. I think these double-digit EPS growth rates are much more reasonable. Let me show you these 4 Ps. I believe Amazon's 4 Ps over the next 2 years suggest that Amazon is either fairly valued or slightly undervalued. For example, Amazon's 4P is expected to be around 31 this year. I believe this is very reasonable, given that Amazon's EPS is expected to grow by around 15% this year. Next year, Amazon's 4P is expected to drop to around 26. I believe this suggests that Amazon is slightly undervalued, given that its EPS is expected to grow by around 20% next year. Right now, I'm developing this investing application with a friend. This is a preview. This investing app will be out this year. The orange line is Amazon's fair value. The blue line is Amazon's share price. These dotted lines are price targets. At the time making this video, Amazon is well below its fair value line. Amazon's fair value should be around $240 per share. In comparison, Anna's average price target is around $243 per share. Our price target is much more conservative at around $205 per share. Typically, the stock is likely undervalued when it's well below its fair value line and these two price targets. This means I believe Amazon is likely undervalued with a good margin of safety now. I also calculated Amazon's intrinsic value using this intrinsic values model. If you want this intrinsic values model, you can download it from my Patreon blog. The link is in the video description. I'm using a simplified sum of the parts valuation model instead of a DCF model to calculate Amazon's intrinsic value. The reason is that Amazon has several different businesses, so it's better to use a sum of the parts valuation model. Let's go over these businesses. For Amazon's online stores and third-party seller services, I'm using Walmart and eBay as comparable companies because they are Amazon's biggest competitors in online stores and online marketplaces. Based on an average price to sales of 1.86, I believe this business intrinsic value should be around $748 billion. For Amazon's physical stores, I'm using Kroger and Costco as comparable companies because they are Amazon's biggest competitors in the grocery business in the US. Based on an average price to sales of 0.64, I believe this business intrinsic value should be around $14 billion. For Amazon subscription services, which include Amazon Prime, I'm using Netflix and Spotify as comparable companies because they are Amazon's biggest competitors in online streaming services and music subscriptions. Based on an average price to sales of 5.02, I believe this business intrinsic value should be around $223 billion. For Amazon's advertising business, I'm using Alphabet and Meta as comparable companies because they are Amazon's biggest competitors in online digital ads. Based on an average price to sales of 6.29, I believe this business intrinsic value should be around $353 billion. For AWS, I'm using Microsoft and Oracle as comparable companies because they are Amazon's biggest competitors in the cloud computing business. Based on an average price to sales of 8.1, I believe this business intrinsic value should be around $871 billion. Once we add all these businesses together, Amazon's intrinsic value should be around $2.18 trillion for the entire company, or around $202 per share. I also used a forward sales valuation model to estimate Amazon's intrinsic value, which should be around $2.24 trillion for the entire company, or around $208 per share. If we calculate the average of both valuation models, I believe Amazon's intrinsic value should be around $205 per share. Just to compare, Morningstar has given Amazon a much higher fair value of $240 per share. This means I believe Amazon is slightly undervalued now. So will I buy Amazon stock? My answer is yes. I plan to continue buying more Amazon shares over time because I believe it's one of the best companies for long-term investing. I believe Amazon has a wide economic moat across multiple businesses, including its online retail business, third-party seller services, fulfillment networks, Amazon Prime, advertising business, and AWS. Amazon's economic moat is built on its large economies of scale, cost advantage, strong network effects, largest user base and third-party seller base, large enterprise customer base, and first-mover advantage in cloud computing. Over the long term, I believe Amazon's advertising business and AWS will be the main drivers of operating income and free cash flow growth. This is my prediction. I believe generative AI and strong demand for AI workloads will accelerate AWS value growth over the next 10 years. Now, all these are only my opinions and my analysis that's based on my research. They are not financial advice. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.